Hello and welcome to MF Corner. I'm Sonal Bhutra, and today we'll try to decode one of the most important parts of investing when you do that via mutual funds, decoding the total expense ratio. It's so important to understand how much money you're giving and what are you giving it for. So what exactly goes into TER, what does not. In today's Mutual Fund Corner, we are joined by Nisreen Mamaji of MoneyWorks Financial Services and Shweta Rajani of Anand Rathi Wealth to help us break down every component of TER and understand how even a 0.5% difference in expenses can significantly impact long-term returns and a lot more, because as an investor, it's very, very important to understand where your money is going. Ladies, good afternoon. Thank you so much for joining in. Shweta, let me start with you first up. We have spoken earlier when some consultation paper indicated there could be change to the TER regime overall. But as of now, what exactly is the total expense ratio? What does it include? And what is kept out of it?
Good afternoon, Sonal. Yes, expense ratios have been in news for the last 3 weeks when the consultation paper came in. But yes, in current regime, now what happens? Firstly, it's important to understand that total expense ratio is the overall cost that one pays of investing in a mutual fund. It covers, the operational costs, the fund running costs of this scheme. This is regulated by SEBI, so there is a maximum limit of how much an AMC can charge as an expense ratio. It's pretty much, visible in public domain as well. And broadly, if you go to any website of the AMC or AMFI, you will see three heads. One is the base TER. Second one you would see is something called as expense charged in the lieu of exit load. And there is a component of GST on management fees. Let's take an example here. If it's a 500 crore scheme, the base TER fixed by SEBI is 2.25. On that, a 5 paisa of exit load makes it 2.3. And let's say the GST on the management fees is 10 paisa. So 2.4% is the total expense ratio of this scheme. That's what the investor would be paying. A further breakdown of this now. In this base TER of 2.25%, there are subheads under which the fees is getting charged. The first one would be the management fees. That's the fees that the AMC or the scheme is charging for doing the research, running the fund. Then there is a second component, which is sales and marketing. So whatever expenses are needed to market the scheme, to pay to the distributor, would come under this head. Third is your transaction costs. So brokerage that the fund manager would be paying on doing the underlying trades of the scheme. And the fourth one, I would say, would be the operational costs. So what the scheme pays for, let's say, an RTA, the registrar, the custodian, the trustee, the fund accounting team. So those are your operational expenses. And there will be, again, a GST on these operational costs. So this is how the broader framework works. And this is all that's included when I say a TER. But what you see on the AMFI or on the fund fact sheet is what you are paying entirely for the scheme that you're investing in.
Okay, before I come to you, Nisreen, just to follow up on this, Shweta, are all of it under AMC's control? Of course, not the GST, but other than that, how much of it is controlled by the AMC? How much of it can be left to the market forces or the RTAs or the distributors as well?
Yes. So, let me again break this up into three parts where there is a very low control of the AMC. So fees like what you're paying to the registrar or the custodian, there's very less space of what the AMC can negotiate, because these costs are anyways smaller and they depend on the number of transactions that are happening in a scheme, how many SIP folios, the size of the scheme. So there's very little control of the AMC here, plus the statutory that goes to the government, there's no control. The second layer where I can say there's a medium kind of a control where, it could be the brokerages that they pay on trades. Now, this, again, is been in news, especially after the consultation paper came in saying that you are paying around 10 to 12 paisa. It can be controlled and brought down to 2 to 5 paisa. So that's the second level, which is controllable. The third, where there is a high control, is the component of management fees, which, the AMC charges for their research and running of the scheme. The marketing and distribution, which goes towards marketing the scheme, doing the sales of the scheme, and the commission that goes to the distributor. So that is the layer, the top layer, where there is far more control and can be negotiated by the AMC.
Okay, take that point. So these are some important takeaways. This is what total expense ratio looks like, what is under AMC's control, and what is something that an investor has to pay because it's a regulatory requirement. Nisreen, in that case, how should a first-time investor read a fund's fact sheet to understand the expenses they are paying? Because, you know, sometimes we don't even understand it in the fact sheet. So if you can give us a point-by-point understanding, if an investor is investing for the first time or even further after that, what should they look out for?
Sure. So basically, they should be looking for the total expense ratio. That will be different for a direct investor and for a regular investor. Usually, you find that on the first page or the last page of the fact sheet. Then another ratio that they should be looking at is the portfolio turnover ratio. So this is basically, a fund with a very high churn ratio will obviously affect the NAV, which will be thereby reduced. So this is, typical in, say, like a small cap fund where the churning would be higher. The buying and selling in that fund would be, higher. So that's called the portfolio turnover ratio. And that also affects the, the NAV and the total returns that the investor will get. So a moderate turnover ratio is usually healthier for a long-term investor planning. Then there is something called, the actual management fee, the expense breakup. So what is the management fee and what are the recurring expenses? That is also very much mentioned in the fact sheet itself. So the, first time or a regular investor would be, wise to look at that. And then, they can be also looking at the benchmark returns and the category comparison. So if you want to know whether, your fund, how is it performing compared to the benchmark or to the peer group, you could also look at that to know that, you are possibly invested in a fund, which is typically in quartile 1 or 2 over a period of time. So that's something that, would be very important for the investor to read in the fact sheet. So the turnover ratio or the churn ratio, the total expense ratio, the expense breakup, as well as the benchmark and category comparisons. So I think, you already mentioned what the TER components are. So it's basically the fund manager, the research costs, the distributor commissions, if it's a regular plan, the RTA fees, custodian charges, servicing the investor accounts, audit, legal, custodian, mandatory regulatory expenses, and the administrative and marketing costs. So I think it's already been discussed.
No, absolutely. Take that point, Nisreen. Shweta, there are some ratios as well. It's not easy for every investor to understand that as well. But if you can just point them out, list them down, and just simply put what they mean for any investor when they are investing in a scheme in an AMC.
Sure. So, apart from the expense ratio, which is already mentioned, there's a turnover ratio, one ratio which is there in the fact sheet. Now, the turnover ratio basically means that how much of the portfolio is undergoing a change. If it's 50%, let's say that it means that 50% of the AUM has undergone a change. This could be on account of the fund manager doing active calls, or it could be on account of, new money coming in. That's why the turnover ratio would be a certain number. Then there is standard deviation, which is mentioned, another ratio, which is nothing but it's a measure of volatility. Now, to explain it in very simple terms, see, somebody is investing in FD, you're getting a standard 7% rate of return year on year. But if you're investing in equity, in 1 year, you could have got 10%. The next year, you could have got -5%. The third year, you could have got 3%. But you've averaged out as, let's say, 12% on a 3-year basis. So this volatility gets captured in standard deviation. The higher the standard deviation, it means more volatility in the fund's return. Then you have something called as a Sharpe ratio, generally mentioned in fact sheets. Sharpe ratio is, again, a ratio which is telling you for every 1 unit of risk that you have taken, how much is the extra return that you have made. Extra return is the word I mentioned. Extra return means the fund's return minus the risk-free rate. So let's say over here, the fund has delivered a 14% return, but your risk-free rate would be around a 6.5% return. So if you divide that, 14 minus 6.5, that becomes 7.5. That's your extra return. For that 7.5, let's say you've taken a risk also, which is 7.5. The volatility, the standard deviation is 7.5, which means for every 1% of risk you took, you got 1% extra return. So higher the Sharpe ratio, the better it is, when investing in a scheme. So over and above the expenses, because in an actively managed equity fund, your expenses can be on the higher side. But if some of these components, the standard deviation is low, but the Sharpe ratio is good, then it may still be worthwhile considering.
Take that point. Shweta, when we say a particular expense is related to a scheme and not the AMC, because the new consultation paper also indicated there could be cut in some charges, but as we spoke about earlier as well, you said it will go to the scheme and not the AMC. If you can explain the difference between the two.
Correct. So, see, there are some expenses which are the fund running expenses that go back to the scheme. For example, this 5 paisa which is charged on account of the exit load, this goes back into the scheme. So if a scheme has an exit load and it's charging you a fees for that, whatever exit load is charged is getting back into the scheme, benefiting the other investors in it. Then you could have the RTA fees, the operational expenses of the scheme, which goes back into the scheme's balance sheet. Then you could have some amount of this, so-called management fees, which a part of it goes to the scheme because there's research, trading, all of that happening, and it's being charged to the scheme. There's some component which goes.
Okay, all right. Looks like there is some technical issue, but we'll get back to Shweta in a bit. Nisreen, if you would like to answer that, what is the difference when we say an expense is charged to a scheme versus when it's charged to an AMC?
Right. So the scheme cost basically would be, whatever is directly related to the scheme, and the AMC level would be at the higher level, So certain expenses are directly related to the scheme itself in terms of, the registrar costs, etc. So there is a difference in that is certain, those expenses which we easily justify by charging it to the scheme, and certain expenses like, the overall marketing expenses of the company, the advertising expenses, those would be related to the AMC level. So that is how they are, divided between scheme level and AMC level.
All right, take that point. We have a lot more questions, but we have to get into a quick commercial break. When we come back, we'll continue our discussion on the other side. Welcome back. You're still tuned into MF Corner. We still have with us Nisreen Mamaji of MoneyWorks Financial Services and Shweta Rajani of Anand Rathi Wealth. Ladies, we have spoken about a lot of things. The most important being the breakup of total expense ratio, and some of it which is not in the hands of AMCs, and some of it which can be changed according to the scheme and other factors involved as well. Just coming back to the question on the cost structure, Nisreen, is there something which is non-negotiable for an AMC, and what are the real challenges that an AMC faces in keeping the TER low?
So basically, what happens is that the TR, the compulsory components will typically be the fund manager and the research costs, distributor commissions for regular plans, the selling and administrative, RTA, custodial, legal. But the TR will not include, brokerage and trading costs, for example, the STT and the stamp duty, the exit loads, the market impact cost, taxes on capital gains. So some parts which are hidden but which are very important are the the bid-ask spreads. When you're buying and selling in certain derivatives, there are bid-ask spreads. The market impact cost, the exit loads on units, and the securities transaction tax. So these can be approximately say 0.5 to 1%. Now, these are, obviously not controllable because that's part of running the fund, and, the fund manager will have total discretion on how to run the fund in that case. So what the AMC can control, is its own operating efficiency. For example, the team size, the systems, the distribution decisions, the marketing costs. Some costs are regulatory, which are like through external partners like the custodians, the auditors, the registrar. So that part is mostly not controllable. But when we say something is scheme related, we mean the expense which is arising because the scheme exists. So for example, the custody of the securities, the audit of the scheme, the investor servicing for that specific fund, these aren't general AMC overheads and they belong to the scheme. So those are some things, which can be either controlled or not controlled at the, AMC level.
Got it, got it. Shweta, and what is the real difference between, say, direct and regular plan expenses? What value does a regular plan justify for the higher TER? Because every investor would like to ask, why should I not go for the direct one and go for the regular one?
Absolutely. So see, if you're comparing a scheme, the same scheme, direct and the regular plan, the differential could be anywhere between a 0.75 to 1.1%. So if let's say I have ABC large cap fund direct plan versus ABC large cap fund regular plan, you'll see this difference. Now, what happens is, let's say a large cap fund itself, there are around 33, 34 large cap funds available to you in the market, each of different sizes, each having different track records. So the difference that a regular plan or a distributor would bring to the table is by saying, out of these 30 funds, these are one or two funds which are good and can give you that extra return over and above the benchmark according to their research capabilities. So where a regular plan works is if the advisor who's doing that entire research for you and coming and telling you, out of this bulk universe, these are the funds that you should invest in. And that covers up for more than that 1% of savings that you could have if you're doing it DIY. You're doing it yourself by researching. Just to give you certain numbers that I have to, talk about, in the last 10 years, if I look at all the mutual funds that are available and I just see the best scheme and the worst scheme in the equity category, the average differential has been around 50% per annum. And here we are talking about trying to save 1%. If you go wrong, the impact can be huge. So therefore, it becomes important that you either understand the funds well and how to evaluate them, then go in for a direct plan, or be with a distributor or an advisor who's doing this entire back-end research for you and covering up for more than the cost saving that you could have over that direct. So value being created could be the decision maker.
Got it. Value being created, because that's the end goal, right? To create more value for any investor, be it the direct way or the regular way, whichever way works for any investor. Shweta, let me ask you this one and then let me come to Nisreen, because we do see some of the other categories tend to have higher TERs than the usual ones. Say small caps have larger total expense ratio versus large cap funds. Is it justified?
So, see, what happens is generally when an AMC launches new schemes, they first launch with the large caps, the flexi caps, and then they go to the small cap schemes. So most of the times it so happens that for that same AMC, the small cap scheme may have a lower AUM than compared to the large cap scheme. And it's important to understand that your expense ratios are defined, your caps are defined by SEBI. So rather than comparing, a large cap fund universe and a small cap fund universe and seeing the TER differentials, you would rather break it up into AUMs and see AUMs or funds which may belong to different categories but have similar AUMs. What are the expense ratios of that? And I had done this check here. If I'm looking at schemes which are more than 10,000 crores of AUM, a large cap fund may have an average TER of around 1.59. Small cap scheme with more than 10,000 crores may have an expense ratio of around 1.62. That's a marginal difference. Likewise, if you look at schemes which are more than 50,000 crores, large cap, flexi cap, mid cap, small cap, there will be hardly a difference of around 2-3 paisa. So the right way to look at it is, if you have schemes which belong to the same AUM bucket, if you have one scheme which is charging way more of 6 to 7 paisa more than the other scheme, then it should worry you, but not like just looking at category averages of AUMs.
Okay, take that point, Shweta. So the point is that we should not just look at a simpler way that small cap categories have higher TERs, and whether that's justified or not, it's different for every scheme as well. Nisreen, if an investor holds a fund, say, for 10 to 15 years, what do you think can a 0.5% difference in total expense ratio actually impact in terms of wealth creation? If you can give an example for that as well.
Sure. So, if you invested, say, 10 lakh rupees and you stayed invested for, say, 20 years and your gross return is, say, about 12%. So if, the difference between the regular and the direct is, say, 0.5%, what the impact would be is, if the total expense ratio is, say, about 1%, then your net return is obviously 11% because your gross is 12. So you would have in your target corpus about 80.6 lakh rupees. But if your total expense ratio went to 1.5%, where your net return went down to 10.5%, your corpus would be looking at about 74 lakhs. So the difference that you're looking at is about 6.6 lakh rupees over the 20-year period, which is approximately, say, 2,750 rupees per month. So if you get the service that you expect, either from the distributor or the, because you've gone in for a regular plan and you've paid those distribution charges, then if it can be justified only if they have helped you through the asset allocation process. One very important criteria is that have you lasted the 20 years? So, a lot of times we find that the direct investors don't really last for such a long period and they tend to stop at the most crucial times, when the market is corrected because, they are lacking that hand-holding and the emotional, advice that is also needed in terms of, a panic situation. So it's very important also to stay invested for the 20-year period. Your asset allocation has to have been right. Your scheme selection has to have been right. Your risk profiling should have been done. So if you feel that, you have been handled in these ways, then of course it is justified. But if somebody is just asking you to fill forms and then sees you that you're going to buy something or you're going to go in ready for an investment and you don't have, the reporting structure in place, you're not really hand-holding the investor, then obviously you should think twice whether you want to be in a regular plan if you haven't got service.
Got it.
So it has to be justified.
Absolutely. I totally take that point. Ladies, it was a very helpful session to understand because it's very important for investors to know what they are paying for, where they are paying, and whether that can be reduced by any means or not. So it was a pleasure speaking with the two of you today.
Thank you. My pleasure completely.
Okay, all right. With that, we'll wrap on this edition of MF Corner for today. But stay tuned for Closing Bell to take you through the last hour of trade.